Hello, this is Jordan, and this video is being recorded on Thursday afternoon, June 9th, 2022. Thank you so much for joining me today. Make sure you like, comment, and subscribe. I would really appreciate it. Thank you. In this video, I am going to talk about how soon and mostly how fast the Fed will be able to shift policy. You've probably have been hearing me talk about this ad nauseum for the last several months, blah, blah, blah. When the Fed shifts policy, precious metals are going to rebound and go up again, blah, blah, blah. You're probably getting tired of me talking about that. So I wanted to do a video delving into the history behind Fed policy shifts and how that might inform what could happen over the coming months. So here's some data, and I just added to this. This was in my 2019 book, which I am updating. And because at that point in time, 2017, 2018, it was clear to me, the market would turn when the Fed would shift policy. Precious metals bottomed, several months before the Fed shifted, but then they really didn't appreciate significantly until the Fed cut rates. And that was 6 months after the last rate hike. So we're looking at, 65 years of history here. And the average and the median, if we take it all in, is about 5 months. So 5 months of time between the last rate hike and then the first cut. And what's really interesting is, so there's 13 data points here. And 6 of the 13, the Fed went from a hike to a cut within 2 months. And what's really interesting is all those but one were in a period where inflation was fairly high. And so what's interesting is the small amount of time between a hike and a cut that mostly occurred during inflationary periods, which, that doesn't seem like it would make a lot of sense. But maybe in the late 60s, 70s, and 80s, there was just the reality had set in that inflation wasn't going to go down to 2 or 3%. It was going to be 5 or 6% or 4 or 5% at a low point. That was going to be the low point during those decades. So, how that informs the months ahead. We are in a similar inflationary period, and so the Fed can actually shift policy, or they have in the past. They've shifted policy much faster during inflationary periods. And, part of the reason for that could be that during an inflationary period, inflation is really volatile. It can move all over the place. Even though the secular trend is up, within that, it can bounce up and down significantly. And at the same time, we know that the economy is more important than inflation. It still is. So this isn't going to be 1929 to 1932 where they if you want to wring out inflation to 0 or 1%, we're not going to have a depression. We're not going to go through that again. We've already, at least a deflationary depression. So when you think about that, yes, inflation is a problem. Everybody wants it to come down, but the Fed they're not going to completely crush the economy into a depression. Nor were they going to do that in the 60s, 70s, and 80s. So, and in addition to that, now we have a serious debt problem where, we can't raise rates to 3% or 4% with the amount of debt that's out there. It has to be devalued and repaid via inflation over time. So I hope I'm not getting too off track here, but, that's the point. The Fed can shift policy pretty quickly. And the other point I want to make is, and maybe this chart will be a little confusing, but the other point I want to make is the Fed shifted policy quickly Yes, they did that during inflationary periods, but they also did that when the rate of inflation was fairly high. So in this chart, I have the CPI at the top. I have gold stocks at the bottom. That's the Barron's Gold Mining Index. And so the vertical lines are when the Fed cut rates. And the thick vertical lines, that's when the Fed shifted policy within 5 months or less. So the light vertical lines, yes, those are rate cuts, but there was more than 5 months between that cut and the previous hike. But I noted what the rate of inflation was during some of these cuts. And I mean, look, 1989 was over 5%, mid 80s, nearly 4.5%. 1974, they cut rates before inflation peaked. Inflation peaked at 12%. 1970, Nixon pressuring the Fed to get the economy going so he could get reelected. Inflation was at 6.3% when they started cutting rates. So this idea that the Fed is not going to cut rates because the rate of inflation is at 6 or 5%, it's just not, that's not going to be the case, because for several reasons. First, because the economy is more important. Second, because we're not going to want to go into a debt crisis and a deflationary depression. And the other reason is when it appears that the economy is in recession, at this point, the S&P will have probably rolled over again. Maybe it's made a lower low. When those realities set in, the psychology is going to impact inflation, and it's going to the thinking will set in that inflation will peak and roll over. And in addition to that, a lot of the inflation now, yes, a lot of it's monetary, but a lot of it, you have the supply chain. You have the issue with oil. I mean, the Fed cannot fix the supply chain. They cannot fix the oil issue unless they want to raise rates to 5 or 6% and put us into a depression, which they're not going to do. So I guess my point is, well, I shouldn't say I guess, but my point is the Fed is probably going to shift policy really quickly. They're going to get in these hikes in June and July, most likely. If they're able to hike in September, they could turn around and cut rates. I mean, they could turn around and cut rates in a month or two after that. If July is the last hike, then, I mean, who knows? Maybe the meeting after September would be, maybe in either case, the meeting after September could be ripe for a rate cut. And that's another reason why they want to get these hikes in, so they have room to cut rates. But when the economy rolls over and the stock market rolls over, it doesn't matter where inflation is. They're going to cut rates. I mean, history shows that. History shows they cut rates. I mean, look at where the rates of inflation were when they cut rates. And we didn't have a debt crisis. 6%, 5%, 10.9%, 14%, 12%. They're going to cut rates before the end of the year. That's all for this video. Let me know what you think. Follow all my work at TheDailyGold.com. Really appreciate you watching the video, and I'll see you guys again in the next video.